Section 2, Nature and Cycle of Real Estate Finance. Unit 1, The Importance and Nature of Real Estate Activities. Activities influencing real estate. Events indirectly impacting real property occur at a regional, national, or international level. Regional/national/international economic events. National environmental regulations. Regional/national/international political events. Events directly impacting real property occur at a local level. Zoning ordinances. Lending activities. Political activities. Employment trends. Local environmental regulations. Building standards. Mortgage lending activities. Consumers save money and deposit it in a bank. Most homebuyers do not pay cash for a house, so they have to borrow money. Banks use deposits from savers to lend money to borrowers to purchase a house. Without lenders, development of new properties would greatly decrease, as well as purchases of homes. Borrowers make monthly payments, plus interest, to lenders. High interest rates make borrowing more expensive, diminishing the number of buyers in the market. Low interest rates make home purchases more affordable to more consumers and entice existing homeowners to refinance higher rate loans to lock in lower rates. Lenders use the interest payments from borrowers to pay interest to those who have money deposited with the bank. Lenders often group mortgages together in packages to then sell on the secondary market. With the cash they earn from selling mortgage packages, lenders can offer new loans to other borrowers. The nature of real estate finance. What would homeownership be like if you had to pay cash for every home purchase? How many of us could afford to own our own home? Fortunately, financing extends the opportunity for homeownership to many. Credit for borrowers. Credit allows us to own homes and goods now that we then pay for over time. With real estate, this is for a very long time, often for 30 years or more. Of course, this long payoff term means that the home will cost us a lot more than its original price tag, because of the interest that must be paid for the loan. The regular monthly payments include interest as well as principal. Interest for lenders. But the interest is what gives lenders incentive to make the loan. Loans are an investment for banks and other financiers, and they allow lenders to accumulate funds through regular monthly payments that they can redistribute to further economic growth. Financial symbiosis. This symbiotic relationship between lender and borrower works nicely, except when it doesn't. If, over a prolonged period, more funds are withdrawn from financial institutions than are deposited, this can create what's called disintermediation. And lenders will naturally curtail lending, which results in an economic slowdown. The desire for money creates a competitive environment within the economy among consumers, businesses, and the government. To add balance, the Federal Reserve, the Fed, and the secondary mortgage markets help to redistribute funds and do their best to ensure that adequate cash remains available. Types of financing relationships. Besides your word and good credit, what would convince a lender to hand you $350,000 for the purchase of a new home? Lenders don't simply hand out thousands and thousands of dollars to borrowers willy-nilly. What happens if a buyer defaults on the loan? Is the lender out of luck? Hardly. Hypothecation. Even though it sounds like something you may have faced with trepidation during high school algebra, trust us, it's not. Because lenders want something in return for the risk they're taking in making a loan, the interest borrowers pay isn't enough. They require borrowers to use the property they're buying as collateral for the loan. Borrowers keep their rights of possession and control of the property, but if they default on the loan, the lender will take over the property, foreclose, and sell it to recoup its financial losses. The security instrument, whether a mortgage or a deed of trust, gives the lender an equitable right in the property, the right to foreclose on the property in case of borrower default. This right remains until the loan is paid in full. That's hypothecation in action. Example. Tristan and Louise are buying a house for $465,000. They put down 20%, $93,000, and then get a loan for the balance of the purchase price, $372,000. Their lender required them to use the house they're buying as security for the loan's repayment. Tristan and Louise will have their rights of possession and control of the hypothecated property, but if they default on the loan, the lender will foreclose and sell the house to recoup its financial losses. Pledges. A pledge is different from hypothecation in that the owner actually surrenders possession of the property to a lender to hold as security for a debt repayment. Stock certificates are commonly used as pledges for a loan. Once the borrower repays the loan, the pledge is returned. But if the borrower defaults, the lender can sell the pledged items to regain the principal and interest amount. Leverage. Another way to look at real estate financing is leverage, which is using various financial instruments or borrowed funds to purchase and/or increase a property's or other assets' potential return. Leverage comes into play with real property financing when borrowers put down a percentage of their own money, the down payment, in order to purchase a property of which they can use, enjoy, and control 100%. Real estate investors are highly interested in leverage. If an investor puts 10% down on a property worth $350,000, $35,000, and that property appreciates 20% over 6 years, the investor earns 20% on the entire $350,000 value, not just on the initial $35,000 invested. Ownership interest. So who really owns the property when it's used as collateral? This gets to the question of title to the property, and the answer is, it depends. When a mortgage is used to secure the property as collateral, the borrower holds both legal and equitable title to the property, but the mortgage document places a lien on the property. The lien gives the lender the right to seize and sell the house should the borrower default. This lien shows up on the property title, and the property can't be transferred without the debt to the mortgagee being satisfied. In other words, the borrower is the legal owner of the property. When a deed of trust is used to secure the property as collateral, the borrower holds equitable title, meaning the borrower has consistent control over the property, and a trustee holds the legal title. Borrowers have the right to use and occupy the property until they've repaid the loan. Once the loan is repaid, the trustee transfers legal title to the borrower. Because the trustee already has title to the property, it's much easier for a lender to foreclose on a property. Every state is different, so always check to see how financing works in the state where you're working. The importance of real estate video transcript. One piece of vacant land, seen with an eye toward development, can put a whole lot of wheels in motion. City planners, engineers, and local concerns may be involved from the beginning. Once the plan is in place, architects, surveyors, utility workers are involved. Then there's the general contractor who takes out a construction loan, orders materials, and hires subcontractors to grade the land, lay the foundation, and add framing. Major systems are added, like electricity, HVAC, plumbing. These all involve specialized contractors. Once the work is complete, it's inspected and given the final permit for occupancy. This is where you come in. Real estate professionals are needed to list the property and represent the buyers. Buyers then keep lenders, title companies, appraisers, and home inspectors busy. In the process of moving, movers are required. Often new furnishings, appliances, landscaping and decor are purchased. New owners may install security systems and set up subscriptions to mail, newspaper, cable. The new owners then frequent local gas stations, stores, and restaurants. Their children attend schools, take part in sports and other recreational activities. And it all began with a piece of bare land. Real estate impacts many aspects of the economy.